Welcome to the March 2024 Quarterly Market Update. I'm Elise Laurenti, Senior Financial Advisor at Perpetual Private. I'm here with Hugo Good and Andrew Garrett from Perpetual Private's investment team.
Thanks for having us on.
Thanks for coming. Now, the share market rally that we saw begin in November last year has really continued through this first quarter of 2024. The performance that we've seen in markets, I think most people would be happy with seeing that in a year. What's really behind that performance we've seen?
We are in pretty interesting times. When we started last year, the expectation was for a recession to occur. And of course, we know that didn't happen, but it's quite encouraging to see the way that the markets are not only growing and moving up, but they're actually starting to broaden. And what we see there actually is it's more of a situation of a lack of bad news. When we think about the data points coming out from the labour markets, they're all coming through strong, despite how high interest rates are. When we look at corporate results, from recent earnings seasons, they're coming through strong as well, and inflation seems to be moving the right direction. So there's been nothing to get in the way of the buoyant market moves. There's been no reason for the rally to stop. So it's quite a good environment. Obviously, there are things to consider with that, but really it's been not so much anything particular driving it. It's been just a broader positive environment that's been driving it.
It's been quite stable and good momentum. Are we expecting that momentum to continue, or do we feel that markets are now priced for perfection?
I'll jump in here. So I think it all depends on whether this soft landing narrative stays intact. If it does, then I think we could certainly see this positive momentum continue later in this year. And so what does that mean? We continue to see lower inflation. We continue to see robust labour markets, strong economic growth, and central bank cuts sometime later this year. However, markets are very forward-looking and they've already priced a lot of this good news in. So if there's anything that disrupts this soft landing narrative, or potentially even just reduces the likelihood of the soft landing narrative playing out, then we can certainly see volatility increasing and maybe a pullback in markets slightly.
There are a lot of similarities in the current economic environment to that of the mid-1990s. We think inflation, interest rates, navigating a soft landing scenario, technology boom. What are our thoughts on that?
Certainly, great question, and it's a good period to refer to and compare our current environment too, because it's one of the few times that central banks were actually able to orchestrate a soft landing. Most of the time when central banks raise rates, as they have done at the moment, it ends in a recession, a hard landing. But it's interesting to look in the mid-1990s because there is a lot of similarities, and they were able to achieve a soft landing. So, as we know, central banks have raised rates, and they're currently, pausing and taking stock and assessing the current market environment. And they did that similarly in the mid-1990s. In addition, labour markets are quite robust. So in 1995, there was a big boost to the participation rate as more women joined the workforce. And we've seen net immigration be really strong, in the last year or two in countries like Australia and the United States, which has boosted the participation rate. We also had huge productivity gains in the mid-1990s. And that was a result of technology like the computer being adopted widely across lots of organisations. We haven't seen that boost in productivity growth just yet at the moment, but there is the allure of artificial intelligence and what that could potentially bring to long-term productivity boost going forward. Remains to be seen to what extent, whether it is the magic wand, but that's what markets are certainly hoping for at the moment. So there are a lot of similarities. And it just gives more evidence to potentially a soft landing being achieved this time around.
It's very interesting, and hopefully we can orchestrate that soft landing. Well, it is pretty clear now interest rates have hit their peak, or hopefully hit their peak, and the next move now will be down. But the question is when? There's a lot of uncertainty around when will they cut rates, how much will they cut rates by? What is our view on this?
Yeah, look, I think the way we would describe that, Elise, is it's a $1 trillion question.
Yeah.
At least.
Everyone wants to know.
Everyone wants to know.
I want to know.
I think we need to think about the decision framework that central banks are following. It's plain to see, and it's obvious that the reason for interest rates being so high is to tackle inflation. And so far, so good. Inflation is coming down and heading back towards the ranges that central banks target, that sort of 2 to 3% level. People are quite early, I think, to necessarily call the top of interest rates. We are at a plateau, and it's likely we've seen the top. But if you look at the conversations coming out of central banks, it's not nailed on. There is still work to do, and in fact, some of that is behavioural in nature. If we think about some of the more hawkish commentary coming out of central banks, what they really don't want to do is, having largely brought inflation down, they don't want to reignite it by encouraging too much confidence within the economy, because that will be self-defeating. So we do think that interest rates are likely to come down. It's likely to be less than what people initially thought. I mean, we've already seen that happen. The sort of higher for longer has actually played out to be higher and longer. So for us, we see interest rates coming down, but nowhere near to the levels that we saw, at the tail end of, say, 2018, 2019. And we're expecting them to come later than a lot of people expect. And it's starting to get to the point where the markets are expecting it is almost out to where we have been expecting for some time. So we do think interest rate cuts are coming. We think it's worth bearing in mind that, with the economy and such, whether it be here or the US or globally, with economies, when they are in strong health, there is actually no incentive necessarily to reduce interest rates. If the labour markets are still strong, if companies are still producing good profits, then you may not need to necessarily cut interest rates. So the one thing that I guess we warn people about is getting too ahead of themselves on the interest rate cuts, simply because people have been talking about cuts since they first started increasing them 2 years ago. So we're not really there yet, but it's coming.
Getting closer.
Exactly.
I'm sure when that time does eventually come, it will be a big relief to mortgage holders, even a small cut. But for investors and retirees, they've benefited from these higher rates. How would eventual rate cuts impact their income?
So as Andrew touched on, we don't think those rate cuts are coming as soon as potentially the market has expected, and they're probably not going to cut as much as people were hoping. So we're not going to see interest rates return back to that early pandemic days where it was almost 0%. We probably think the long run average of interest rates is around that high 2s, low 3%. And so it's important to keep that in mind, that we're not going back to income producing assets yielding very low returns. Interest rates will be remaining higher for longer, even if central banks do cut and come down slightly. So we do expect income producing assets to produce good returns. It's taken a while for those higher rates to flow through into income producing assets, but we do see that happening over the next year or two, and retirees and other people would benefit from income producing assets to benefit over the medium term. Yeah.
So there'll still be pretty good income there. It might just come down a little bit over the long term.
Yeah, I mean, it's worth bearing in mind when you think about what happened with income is, over the better part of 2 decades coming into 2018, 2019, interest rates had only ever gone down.
Yeah.
And that is the sort of, just as a rising tide lifts all boats, that was the receding tide that was dragging all boats down. So coming into the pandemic, the majority of the heavy lifting in terms of income was being done by Australian equities. And of course, as we remember during the pandemic, early on, APRA told banks they weren't allowed to pay dividends. And of course, banks are one of the largest proportions of income generation within Australian equities.
Yeah.
And so we've come from a very low base. And what we see now, particularly, which is good news for those people who like income, is that that the rising tide is now back lifting all boats. And even though that hasn't necessarily flowed through yet, it's coming, and we do expect that baseline level to be permanently higher over the next few years.
There'll be a bit more of a balance between everyone's interests, I'd say.
Exactly.
We have seen a lot of popularity in the responsible investment space over the last decade. I think the feel-good factor of being able to impact change through your investment choices really appeals to a lot of people. Do we see this trend persisting?
Yeah. Ultimately, we think the trend is good and necessary. And and I'll separate those. The necessary thing is, I think we are believers in climate change, and it does appear that the things like the net zero targets will be increasingly focused on politically as we move forward. We've seen the volatile weather situations that have happened everywhere, from Californian wildfires to flooding in Europe, and it does appear that extreme weather events are becoming more prevalent. And so we do think that the political environment will increasingly lean into decarbonising.
Yeah.
So very simply, that's going to feed into that whole responsible investing trend. But equally, even if you're not a full subscriber to the benefits of responsible investing, even if you're not so interested in making an impact, just looking at core components of, say, ESG, the environmental, social, and governance of the companies you invest in, is important, because it gives you a deeper understanding of the risk you're taking when you invest in a company.
Yeah.
So we think it's just best practice as investment managers to take all the information you can to try and make informed investment decisions, and looking at a company's social license and environmental performance and their governance is crucial in doing that. So we don't think it's going away, but of course we have seen such a strong boom in ESG style investing over the past, say, 10 years, that just as shares don't go up in a straight line, no trend really does. Yeah. And so as you will have seen, that as part of the culture wars coming out of the US, there has been sort of a counter trend of people pushing back against that. But we do think ultimately the long-term trend will continue to be upwards.
Yeah. There is a bit of talk about right now being one of the most dangerous times since the Cold War and end of World War II. What are the primary concerns, and are we seeing any impact to markets?
Certainly. It's dominating our headlines. I'm reading it every day in the newspaper. It's the first thing I'm kind of reading when I wake up in the morning. But geopolitical events and risks are always present. I would agree that they certainly are heightened at the moment. Yeah. But it's very hard to predict and forecast geopolitical events and the impact they'll have on financial markets. Certainly, it takes a while for that to translate into financial markets. For example, some of the biggest events that we've had over the last 100 and so years, the World War I, World War II, and 9/11, initially we saw a sharp decrease in markets, 10% or more drop. But then you look at the one-year numbers and the markets were up, actually, in all cases, over 15%. So markets are quite forward-looking, and it's very hard to predict how these geopolitical risks will translate into financial markets. So we do believe it's best to potentially take more of a diversified approach. Don't make any knee-jerk reactions. And sometimes it makes sense to kind of position the portfolio once the event has actually happened, and not before the event.
Yeah, it is a bit, when you see it all on the news, and it's definitely a humanitarian issue, and people really feel it. Mm-hmm. But when it comes to investments in markets, it doesn't seem to have such a huge impact unless it's a huge issue.
Well, that's exactly our belief. That ultimately, as humans, we're drawn to this. It's sad when you see bad things happening to other people around the world. But from an investment point of view, if we're just putting those blinkers on, it's very rare that geopolitical events impact markets. And as you said in your question, we are probably at the most heightened level of geopolitical tension post the Second World War. Yeah. But look at markets. We've had really, really strong performance, and we will caveat that the point where geopolitics does impact markets is when you're talking about the destruction of capital. So if a company you're invested in has a factory blow up, of course that's going to impact your investments. But again, that just sort of feeds into our sort of diverse global approach to investing, which is you're not going to have too many eggs in any one basket, etc. So
diversification, is that the main way we're looking to protect client portfolios against all this geopolitical risk?
I think inherently, from a structural point of view, yes. I think, longer term, we will act if a geopolitical event occurs that drives opportunity, or if we think that we can avoid risk from acting quickly. It's just, our underlying belief is that in most instances, we don't need to do that. Yeah. In most instances, it sorts itself out.
That was a really interesting chat. Good to know, have a bit of reassurance around what we're doing. And thank you both for your time. I've enjoyed it.
Thanks for having us on.
Thank you, Elise.
Thanks.